Welcome to our comprehensive guide on foreign exchange or Forex risk. In today's globalized world, businesses and individuals frequently deal with multiple currencies. This exposure to different currencies brings about unique risks due to fluctuating exchange rates. Understanding Forex risk is crucial for anyone involved in international trade, investment, or finance. In this video, we'll break down the three main types of Forex risk: transaction, economic, and translation exposure. We'll also explore practical strategies to manage these risks effectively, ensuring your financial stability in a volatile currency environment. Forex risk refers to the potential financial loss that arises when exchange rates move unfavorably. This risk affects businesses, investors, and even travelers who deal with foreign currencies. For example, if a company earns revenue in euros but reports profits in dollars, a sudden change in the euro-dollar exchange rate can impact its bottom line. Understanding the nature of Forex risk is the first step toward managing it. Throughout this video, we'll delve into the specific types of exposure and how they can influence financial outcomes. Transaction exposure arises when a business engages in financial transactions denominated in a foreign currency. For instance, if a US company agrees to pay a Japanese supplier in yen 3 months from now, any fluctuation in the USD/JPY exchange rate during that period can affect the actual cost of the purchase. This type of exposure is common in international trade and can lead to unexpected gains or losses. Managing transaction exposure is essential for companies that buy or sell goods and services across borders. Economic exposure, also known as operating exposure, refers to the risk that a company's market value will change due to unexpected shifts in exchange rates. Unlike transaction exposure, economic exposure is broader and affects a company's future cash flows and competitive position. For example, if a European firm competes with American companies, a stronger euro could make its products more expensive abroad, reducing sales. Understanding economic exposure helps businesses plan for long-term financial health. Translation exposure, sometimes called accounting exposure, arises when a company consolidates financial statements from foreign subsidiaries. Fluctuating exchange rates can alter the reported value of assets, liabilities, revenues, and expenses. For example, a US company with a subsidiary in the UK must translate British pounds into US dollars for reporting purposes. Changes in the GBP/USD rate can impact the company's reported earnings, even if no cash actually changes hands. Managing Forex risk is vital for maintaining profitability and financial stability. Unanticipated currency movements can erode profits, inflate costs, or even lead to losses. For multinational companies, these risks can affect everything from pricing strategies to investment decisions. By understanding and addressing Forex risk, businesses can protect their bottom line and remain competitive in the global market. First step in managing transaction exposure is identifying all foreign currency transactions. This includes sales, purchases, loans, and investments denominated in other currencies. By mapping out these exposures, companies can assess their risk and prioritize which transactions need hedging. Accurate identification is the foundation of effective risk management. Once exposures are identified, the next step is measurement. This involves calculating the potential impact of exchange rate changes on each transaction. Companies often use scenario analysis or sensitivity analysis to estimate possible gains or losses. By quantifying exposure, businesses can make informed decisions about which risks to hedge and how much protection is needed. Hedging is a common strategy for managing transaction exposure. Companies can use financial instruments such as forward contracts, futures, options, or swaps to lock in exchange rates and reduce uncertainty. For example, a company expecting to pay a supplier in euros can enter a forward contract to fix the exchange rate, ensuring predictable costs. Effective hedging helps stabilize cash flows and protect profit. Natural hedge occurs when a company's operations naturally offset currency risks. For example, if a business earns revenue and incurs expenses in the same foreign currency, exchange rate movements have less impact. Companies can also match foreign assets with foreign liabilities to reduce exposure. Leveraging natural hedges is a cost-effective way to manage Forex risk without using financial instruments. Economic exposure requires a long-term strategic approach. Companies can diversify operations across multiple countries, adjust pricing strategies, or source materials from different regions to minimize risk. Scenario planning and stress testing help anticipate the impact of currency movements on future cash flows. By staying agile, businesses can adapt to changing market conditions and protect their competitive position. Operational adjustments are practical steps companies can take to manage economic exposure. These include relocating production facilities, renegotiating contracts, or changing suppliers to benefit from favorable exchange rates. By being proactive, businesses can reduce their vulnerability to currency fluctuations and maintain profitability. Translation exposure is managed primarily through accounting techniques. Companies can choose different methods for consolidating foreign financial statements, such as the current rate method or temporal method. These choices can influence reported earnings and balance sheet values. While translation exposure doesn't affect cash flow directly, it can impact financial ratios and investor perceptions. Diversifying currency exposure is another effective risk management strategy. By holding assets and liabilities in multiple currencies, companies can reduce the impact of any single currency's volatility. This approach spreads risk and can help stabilize overall financial performance, especially for multinational corporations. Company's treasury department plays a key role in managing Forex risk. Treasury professionals monitor currency markets, execute hedging strategies, and ensure compliance with internal policies. Their expertise helps the organization respond quickly to market changes and maintain financial stability. Modern technology has revolutionized Forex risk management. Advanced software tools can track exposures in real time, automate hedging transactions, and generate detailed reports for decision makers. By leveraging technology, companies can enhance accuracy, efficiency, and responsiveness in managing currency risks. Establishing clear policies is essential for effective Forex risk management. Companies should define risk tolerance, set limits on exposures, and outline procedures for hedging. A well-structured policy framework ensures consistency and accountability across the organization. Continuous monitoring and regular reporting are vital for managing Forex risk. Companies should track exposures, review hedging effectiveness, and update strategies as market conditions change. Transparent reporting keeps stakeholders informed and supports timely decision-making. Let's consider a practical example. A U.S. exporter sells goods to a European customer with payment due in euros in 3 months. If the euro weakens against the dollar during this period, the exporter receives fewer dollars than expected. By using a forward contract, the exporter can lock in the exchange rate and avoid this risk. This case highlights the importance of proactive risk management. Imagine a Japanese car manufacturer exporting vehicles to the US. If the yen strengthens against the dollar, Japanese cars become more expensive for American buyers, potentially reducing sales. The company might respond by sourcing parts from the US or adjusting prices to maintain competitiveness. This example shows how economic exposure can influence strategic decisions. Multinational company with subsidiaries in several countries must consolidate financial statements in its home currency. If the value of foreign currencies falls, the translated value of overseas assets and profits decreases, even if local operations remain unchanged. This can affect reported earnings and investor perceptions, underlining the importance of managing translation exposure. Forecasting currency movements is a complex but valuable tool in Forex risk management. Companies use economic indicators, market trends, and expert analysis to predict exchange rate changes. While forecasts are never perfect, they provide a basis for informed decision-making and risk mitigation. Financial instruments such as forwards, futures, options, and swaps are essential tools for hedging Forex risk. Each instrument has its own advantages and limitations, and the choice depends on the company's specific needs and risk profile. Understanding these tools is key to building an effective risk management strategy. Hedging is not free. There are costs associated with using financial instruments. Companies must weigh the benefits of risk reduction against the expenses involved. A cost-benefit analysis helps determine the optimal level of hedging, balancing protection and profitability. Regulations can impact how companies manage Forex risk. Different countries have rules regarding currency controls, reporting requirements, and the use of derivatives. Staying compliant with these regulations is essential to avoid legal issues and ensure smooth operations. Effective Forex risk management requires clear communication and ongoing training. Employees involved in international transactions should understand the risks and the company's policies. Regular training sessions keep everyone informed and prepared to respond to currency fluctuations. Forex risk management is an ongoing process. Companies should regularly review their strategies, learn from past experiences, and adapt to changing market conditions. Continuous improvement ensures that risk management practices remain effective and relevant. There are common mistakes companies make when managing Forex risk, such as underestimating exposure, overhedging, or neglecting to update policies. Being aware of these pitfalls helps organizations avoid costly errors and maintain effective risk management. Recap: Forex risk arises from fluctuating exchange rates and can take the form of transaction, economic, or translation exposure. Effective management involves identifying, measuring, and hedging exposures, supported by strong policies, technology, and continuous improvement. By understanding and addressing these risks, companies can protect their financial health and thrive in the global marketplace. As global markets continue to evolve, Forex risk management will remain a critical skill for businesses and investors. Staying informed about market trends, regulatory changes, and new risk management tools will help you navigate the challenges of currency fluctuations. Thank you for joining us on this journey to mastering Forex risk.